Good morning, everybody, and thank you for joining us for our webinar, A Window of Opportunity for Capital Gains Tax. You're joining along with around 80 to 90 people this morning, and I hope you find our session helpful. I'm Andrew Playle. I'm the head of the private wealth sector here at Mills Reeve, and I'll be introducing and sharing the webinar. You'll soon be hearing from three of our resident experts on capital taxes, Deborah Clark, Lizzie Field, and John Grundy. Towards the end of the session, I will chair a Q&A, and you can post questions using the Q&A tab in Zoom. We've also had some questions ahead of the session, so we'll decide towards the end which ones we will cover. We will keep them anonymous, so whilst the presenters know who's posted what question, no one else who is attending will know, and we will not share that information. So before we get into the detail, I just wanted to put this into a little context for everybody. I think the first thing to say is, as we all know, the UK government has never been more borrowed. By the end of last year, government debt stood at 2.13 trillion, and it had grown by over 300 billion within that year, which are just phenomenal figures. You know, hopefully we'll never see those again in our lifetimes. Contrast that with the fact that in the 2019 Conservative Manifesto, which of course was pre-COVID, there was a pledge not to increase income tax, national insurance, or VAT. So that clearly leaves other taxes, including inheritance tax, which we covered in a previous webinar, and capital gains tax, vulnerable to changes. It was less than a year ago now that the Chancellor, Rishi Sunak, requested the Office of Tax Simplification to provide a review, which was published towards the back end of last year. And it's those the subject of that review that the detail later will cover. One of the aspects of the review, before it went into what proposals was, a review of things like capital gains tax historically, how it compared with income tax, etc. So some headlines from that are that capital gains tax rates, as our speakers will explain in more detail, are generally significantly lower than income tax rates. Only 265,000 individuals paid capital gains tax in the previous year, whereas 32 million, so practically half of the population, paid income tax. The capital gains tax raised was only 8.3 billion, whereas the income tax rate raised was 180 billion. So it's very easy to read the report as representing capital gains tax as a tax whose rates are low, that is paid by very few people, and that consequently raises little revenue. So with that in mind, I'm now going to hand over to Deborah Clark, who will begin by summarising some of the key proposed reforms.
Thank you, Andrew, and good morning, everybody. So we're going to spend the next 10 minutes just running through the proposals set out in the report. And we're looking at capital gains tax, which is, of course, a tax on the difference between an asset's value when acquired and its value at disposal, less any available expenses. And probably worth just reminding everybody that's two key exemptions. One, of course, is your family home. So there is no tax on your family home generally when you buy and sell it. There's nothing in the report to suggest any more changes on main residence relief, which I'm sure is very welcome. The other one that I'm conscious that many of my clients will be quite interested to know about was there any mention about classic cars? Well, I can't see anything in the report, so I think we're okay on that. Cars are still going to be exempt from capital gains tax. Anyway, let's move on and look at what's in the report. So, 4 key areas being considered by the report, making recommendations. We've got rates and boundaries, as Andrew's already alluded to, the annual exempt amount, capital transfers, and this is tying in a little bit with our last seminar on the changes to inheritance tax, and we'll pick up on that later. And then finally, a little bit on business relief. So let's start with rates and boundaries. So currently we have 4 rates of capital gains tax. And the rate you pay depends not only on what your income tax status is, but also on the type of asset. So we've got rates that range from 10% if you're a basic rate taxpayer, right up to 28% if you're a higher rate taxpayer and you're selling a residential property. And that's, of course, not your main residence, so a buy-to-let property. Quite a complicated regime, particularly when we look back at what the rates have been historically. Capital gains tax first introduced in 1965, and the rate was 30% right up until 1992. And when life started to become much more complicated, rates started coming down and new reliefs coming in. So quite a complex picture. So let's move on and look then at the recommendations. So as Andrew's already said, the first thing that the report highlights, which has probably been well publicised so far, is the suggestion that income tax rates should start to be aligned with capital gains tax. So this idea that income and capital gains tax should have very similar rates. Now, the report itself doesn't actually tell us what those rates are going to be. And as I've already mentioned, capital gains tax was historically at 30%. So might we see something like that? But the idea is, of course, that we get some aligning of the 2 rates. And also the recommendation is that we reduce the number of tax rates and remove this link to as an individual's income. So again, all about simplification, maybe a single rate capital gains tax across the board. Now, the report does say that if the government was to adopt those changes, then it should consider reintroducing some form of relief that impacts on inflationary gains. Now, I'm sure many of you will remember that we used to have an allowance called indexation allowance, which was designed at taking out the inflationary element of a gain. And the report is suggesting a reintroduction of something like that. The report also talks about allowing for the more flexible use of capital losses. They don't really go into detail here, but I think it's just a general suggestion that if you're going to be paying capital gains tax at a much higher rate, then where you do make a loss, there should be more opportunity to utilise that loss. So that is probably quite helpful. And one of the questions we got pre the seminar was about the use of capital losses that already exist, and will there be any kind of limitation going forward? And I think there's certainly no mention of that, and that would be a very unusual move for a government to make. And the suggestion that actually the use of losses may be more flexible, I think probably certainly confirms that you're unlikely to lose the benefit of losses that you've already incurred, which is probably good news. Another question that came in pre our seminar was around deferred gains. So if you've had a capital gain which was deferred because you've by either EIS investment or by rolling over into some form of loan note on a sale, when those gains come back into charge, will you be paying at the new rates introduced, or will you still get the benefit of the rates that were around at the time the gain originally occurred? Well, the answer to that is there's no suggestion of any change of the current rules, which is very much that any gains that were historic but don't come into charge until a subsequent tax year will get taxed under that new regime. So if there is a higher rate of capital gains tax, you would get caught for it. Now, a couple of interesting things for smaller owner-managed companies. And as to what we mean by smaller, probably a company that falls into the closed company rules, which very broadly means if it's a company controlled by 5 or fewer people. Now, for those kind of companies, this whole idea of aligning income with capital rates, the report makes 2 suggestions, one of which is that retained profits should be taxed at income tax rates when either the company is sold or if the company is wound up in a liquidation. Now that would be obviously quite a change from the current regime, where any profits not paid out as a dividend and held in the company on a sale, you would normally hope you would pay capital gains tax on. So that would make quite a material difference. In some respects, however, I take a little bit of comfort from that proposal, because there had previously been some suggestions of reintroducing the old rules, which were about the apportionment of profits, which actually taxed retained profits in the company on shareholders if the company was felt not to have been paying out sufficient dividend income as it went along. So the idea you'd only be taxed on a sale or liquidation is a bit better than that. But clearly potential changes there might be on the cards. And the final one, which is probably slightly surprising, is the report seems to suggest that the tax incentive schemes that we have around employee schemes, where individual employees are given a sort of share in a company as a reward, those schemes are all been very much designed to encourage wider share ownership amongst the workforce, and they have a lot of attractive tax treatments. The suggestion that those sorts of benefits should actually be taxed at income tax rates and not capital gains tax rates perhaps seems a bit counter to the aims of those bits of legislation, but it was an interesting recommendation that was in the report. Okay, let's move on to the annual exempt amount. This one's a bit quicker and easier to deal with, I think. Currently, we've got a rate of 12,300. The report looks at what's the purpose of the relief. Is it there just to take people out of capital gains tax so they don't have to file tax returns where they wouldn't ordinarily need to? Well, the report's looked at this and actually has worked out that if that is the aim of the annual exemption, then the rate only needs to be about somewhere between 2,000 and 4,000 in order to achieve that objective. So the suggestion in the report is that the annual exemption is reduced quite materially. To counter that, again, they've suggested that if you reduce the annual exemption, you should perhaps broaden the exemption for chapels to cover wider personal effects. Not clear quite what sort of things they're thinking of that wouldn't be covered that will be under that broadening, but perhaps it's just really about simplifying those rules. And then the final bit here, recommendations, is really about the reporting. So considering sort of accelerating reporting, real-time capital gains tax service being introduced, that's sort of in line with lots of other reporting changes that we're seeing with the government. And perhaps the final one's very surprising, actually exploring whether investment managers could report gains when they buy and sell shares in somebody's portfolio directly to the revenue. That's I'm not sure will be a particularly welcome change in the investment managers world. So capital transfers, that's the third area of potential change. And this one, in some ways, if you attended our last seminar, you might be already sort of aware of the fact that the government might be looking at this. And this is the idea of reducing or removing the impact on capital gains tax of death. So what generally happens now, if somebody dies, and let's assume somebody's got a buy-to-let property that's worth 250,000. They bought it at 200,000, so it's currently standing at a 50,000 gain. Now, if they were to die owning that property, and that property was then left to their spouse, the spouse would inherit it at its market value at the date of death. So that's the 250,000. Which means that if they then immediately sold that property or passed it on to the children, then actually no capital gain would arise. And there would have also been no inheritance tax because the asset passed to a surviving spouse. So you get this benefit of a double relief. And that clearly is something which the writers of the report feel is overly generous, and they're suggesting that actually you shouldn't get an uplift in capital gains tax in that circumstance. They also, though, as a secondary recommendation, said the government should think about removing that uplift in all circumstances. So not only where there's no inheritance tax, but that definitely feels like double tax if you're going to pay inheritance tax and still got that capital gains tax potential to pay when the asset's eventually sold. So if those rules were adopted, the report does make some other recommendations that effectively go with them, which says if you were to remove the uplift on death, then the government should consider rebasing assets. Now, you may remember we did a rebasing exercise back in 1982, and I certainly remember my early part of my career doing lots of work around that. Well, they're now thinking of rebasing again to the year 2000. Which I was thinking wasn't that long ago, but of course it is now over 20 years. So still a lot of gains and a lot of history there to be recorded and to be retained so that people have know what an asset cost. And the final thing was, if you did bring in these rules, then the report suggests there should be a much widening of the rules around holdover. Which basically means if you gift assets to an individual, even if it's not a business asset, you should be able to potentially defer the capital gains tax. So that would be a very welcome change if they did introduce these changes. So finally, look at business reliefs. The first one, the first key one really is what we now refer to as business asset disposal relief, which in old money is entrepreneurs relief, as it was. That got changed when the relief was reduced from a 10 million lifetime limit down to 1 million. And you may remember that where the relief applies, you only pay capital gains tax at 10%. So obviously very attractive for taxpayers. Now, the report looks at that relief and says that ideally it should probably be changed to something more like retirement relief, because the argument for its being so generous as it's currently perceived to be is that it's there to encourage investment. But they say that in the report that actually it doesn't really encourage investment. If you're going to encourage investment, look at reliefs at the time you're investing, not at the time you're selling. So what is the purpose of the relief? Well, historically, this relief really has its origins back in retirement relief, which again was the relief we had when I started my career, and it looks like I'm going to end up back there with a very similar changes to entrepreneurs relief. So the suggestions in the report is that whereas now you only need a 5% holding, that would go up to 25%, whereas the current holding period for entrepreneurs relief is 2 years, that would go up to 10 years. And there might even be an introduction of an age limit, so only available perhaps if you're 55 or over. So again, turning that relief back into something that's much more akin to a retirement relief. And the final recommendation was to abolish investors' relief. And if you're asking, well, what's that? I'm not surprised, because one of the things they say is actually they don't feel many people are aware of it. And that's why they're thinking of abolishing it. Investors' relief was, though, only brought in back in 2016. It's a relief for investing in privately trading companies where you have no connection, so you're not employed, you're not a director of the company. It was designed to encourage investment, and it did give you a 10% rate, the same as entrepreneurs relief, if you held the shares for 3 years. So tax returns that have just been submitted would have been the first tax returns to actually claim that relief. So it's a bit surprising they're already talking about abolishing it, but there you go. That's one of the changes they are thinking about. So that was a quick run through the proposals. I'm now going to hand over to Lizzie, who's going to take you through a few examples of what that all might look like if it was adopted. Lizzie.
Thanks, Deborah. So our first example is pretty simple, but just to illustrate what would happen if they did a straightforward alignment of capital gains tax rates with the income tax rates that we already have. So not thinking about having anything special for CGT. So we have Andy in my example. He's got shares worth £200,000 with a base cost of £110,000. He's a higher rate taxpayer, so for income tax, he's paying 40%. But at the moment, because we have his special rules for capital gains tax, it's a separate regime. That gain of £90,000 on a disposal, he can take off the £12,300 of his annual exempt amount. That leaves him with a taxable gain of £77,700, on which he pays CGT at the 20% rate, so £15,540. However, if we align that with the income tax rates, he simply pays 40% on that taxable gain, which just doubles the tax. That takes you to £31,080. And if we have that alignment and we reduce the annual exempt amount to the £2,000 suggested in the report as the lowest level that would be sensible for administrative ease, that actually brings the CGT at 40% to over £35,000. So you can see that's quite a large increase on what he would currently pay and quite a large decrease in the net proceeds that he gets to keep out of that sale. The second example is what might happen if we have no capital gains tax uplift on death. So Deborah alluded to this, but certainly if you have an asset now with a significant gain, it feels unattractive to sell that or to give that away to trigger your capital gains tax, and then you have the risk if you die within 7 years that the value is still brought into account for inheritance tax anyway. So a lot of spouses would look to perhaps pass it on first death, eliminate the capital gains tax with the uplift that we currently have, rely on the spouse exemption, and then take their chances on whether the survivor can make the gift on subsequent to the first death, and then live the 7 years to get it off the clock, as it were, for inheritance tax purposes. So that might achieve getting something down the family with no capital gains tax and no inheritance tax. So our example, Bob and Christine, they have a residential investment property in Bob's name alone. He's got a whopping gain of £500,000 in that. So he's obviously not keen to dispose of that now, because that would trigger capital gains tax at 28%, so that's £140,000. And it's even more attractive if he gives it to the children, because that is what we would call a dry tax charge. So he hasn't sold it, he hasn't got sale proceeds to pay that bill with, he's got to find £140,000 from somewhere else to pay that bill. So what Bob might do is leave it to Christine under his will, eliminate that gain, get the spouse exemption, and then see if Christine can deal with it in her lifetime. As long as she deals with it quickly enough that a gain doesn't start to build up again after Bob's death, that means there's no capital gains tax to pay. She does have the 7-year survivorship of any gifts that she makes, but you might think that overall you might see if you could achieve that planning. So under the new rules, there is no uplift. So Christine is going to effectively inherit the gain as well as the property. So if she then sells the property, she will have that whole gain of £500,000 come into charge. That would be at presumably the same income tax rates if the rates have been aligned. So I haven't told you what Christine's income tax position is, so it might be a mix of the possible rates of 20, 40 or 45%. But if she was a top rate taxpayer, that 45% is £225,000 worth of tax. There's a possibility if she gave the property away after Bob's death, she might be able to claim this extended holdover relief that Deborah mentioned. So again, she wouldn't be paying any capital gains tax, but that effectively defers it again. So say that she gives it to the children and the children then sell it, they are going to have the entire gain come into charge. So my slide gives the example that the gain has by the time of death become £750,000. This is a very good investment that they've made, but they're obviously then paying tax on the entire amount. So at the top rate, that is a very significant £337,500 of tax. However, I've said here, Bob might want to deal with it differently, and actually Bob might need to deal with it differently, because there is a suggestion in the report that that extended holdover might only be if the uplift on death is taken away universally rather than only for where there's an exemption available. So it might be that Bob will actually look to deal with this in his lifetime. If the only thing that is putting him off making the gift to the children before he dies is that he doesn't want to trigger that capital gains tax, then these rules might allow him to make the gift straight to the children. Nothing passes through Christine, as it were, and he claims the holdover relief and then sees if he can survive the 7 years required for inheritance tax purposes to get that value outside of his estate. So you can see that that might encourage slightly different behaviours to the rules at present. Example 3 is just to show what might happen if the business asset disposal relief is restricted. So my table shows you 3 shareholders. We have David, Emma and Frank. They've all got shareholdings in a trading company. They are all employees or directors, and they have owned their shares for more than 5 years in all cases. So they're all going to qualify for the present rules. They only have to have held it for 2, so they're squarely within the qualifying requirements. And if there was a sale, they would each have a £1 million allowance where the gain will be taxed at 10%. So if these were, clients looking at their planning to exit a business, they would currently be thinking, this looks great, we are structured to come within that relief. However, if these new qualifying conditions are brought in, David will still qualify because he has got a 55% shareholding. He's 60, so he looks like he's retiring, and he's held for 20 years. However, Emma is going to be in trouble because Emma is only 40, so she wouldn't be considered someone who is retiring under the proposals. She's not at retirement age, and she's only held her shares for 5 years. So she's got 2 heads on which she will not qualify under these new rules. Similarly, Frank has just 15% in the company. The new rules propose a 25% shareholding as a minimum. He's 54, which I've deliberately put in as a sort of question mark about the age. He might actually qualify on that head, but it's not going to help him because he's not going to meet all of the qualifying conditions. So we would go from having every shareholder in this company qualify for relief to just 1, which obviously could be quite significant for those planning potential exits from businesses. So I hope that's helpful as a bit of a whistle-stop tour. Obviously, we don't know exactly what might be brought in, but Andrew is now going to talk us through the likelihood of some of these changes.
Thank you very much, Lizzie. Yes, after me, John's going to talk about some possible actions, but I've been asked to give what we could probably call our house view on likelihood and timing. I think it's fair to say that it's impossible to be certain about likelihood and timing. However, we do monitor developments really closely, both in the law, but also in the political mood, in the economy, etc., so that we at least can give our best view on this. So I'm not going to dodge the question entirely. So in a recent BBC report, so just in January, the Chancellor was reported as saying that the government's investment of 280 billion in protecting jobs and livelihoods during the pandemic was a fiscally responsible thing to do. And I suspect a lot of people would agree with that. He then went on to say, though, once our economy begins to recover, I think that's a really key phrase, once our economy begins to recover, we should look to return the public finances to a more sustainable footing. So other commentators have looked at this. So one that I was looking at, the chief economist at Pantheon Macroeconomics, his comment on that was the timing of the next general election in 2024, so that's not that far away, suggests that Mr. Sunak will not wait until the economy has fully recovered before rebalancing. So we should expect, his view was we should expect taxes to rise sharply in 2022. So coming back to the questions about likelihood and timing, I would say the likelihood is very high that a great many of the changes, if not all, but the vast majority of these will come in, particularly things like the equalisation of income tax and capital gains tax, at least broadly, a partial or a complete loss of the capital gains tax-free uplift that Deborah was focusing on there, and potentially the sort of restriction on entrepreneurs relief that Lizzie's last slide talked about. So back to timing, our view is that if the rollout of the vaccine goes as planned, it seems to be going strong. It seems to be one of the things that is going well, so that we get lots more people vaccinated, perhaps towards the back end of this year. And if the economy starts to turn a corner with that sounds to me and feels like, doesn't it, the beginning of a recovery. Bear in mind that most chancellors don't like to bring in tax changes too close to an election. So we've all been used to having autumn budgets, which often signpost what happens. So, you know, I would be pretty confident in saying in the autumn budget, we should expect these things to be signposted and maybe start to be brought into force. I'd be more surprised if things came in the March budget, but never say never. So hopefully that gives you some insight. We think these changes are very likely to happen. We think the timeline is possibly within this year. And I'm now going to hand over to John, who's going to talk a little bit about some potential actions that you might want to consider in light of everything you've been hearing up to now. Thank you.
Thanks, Andrew, and good morning, everybody. So, as Andrew alludes to, my focus really is going to be on what actions you might think about taking now, or certainly sooner rather than later, to mitigate the potential impact of these proposals. So again, the focus is going to be on 3 areas that we've already discussed. So that's the income tax, the alignment with income tax rates, or certainly an increase in the capital gains tax rates, the uplift on death no longer applying, so no longer gains being washed out on death, and finally business asset disposal relief, or the old entrepreneurs relief, being restricted in some way. So if we just begin by thinking about making lifetime transfers of assets, lifetime gifts of assets. So as we've heard from Deborah at the outset, so a lifetime gift would be a disposal for capital gains tax purposes. So if that asset, be it property, be it land or investments, if that asset's increased in value, there'd potentially be a capital gains tax charge on that increase in value, on that gain at the time of the gift. And when we're thinking about estate planning, when we're thinking about making lifetime gifts, there's really 3 main options. So the first being the simplest, and that's a transfer directly to, I've put the kids or the grandkids on the slide, but it could be to anybody. It could be to friends if you like. But the lifetime gift to friends is the simplest option. There's another couple of options, and that's you could decide you want to make a gift into a trust for the benefit of the family, perhaps, and that could be a trust that included you still as a beneficiary. Or indeed, it could be a trust that excluded you because we were looking to start the 7-year clock ticking so far as inheritance tax is concerned. Or thirdly, we might be thinking about using a corporate entity. And again, we may be looking at the corporate entity because of the way the inheritance tax rules operate. So those I think are the 3 main options when you're thinking about lifetime gifting. So let's just walk through the potential attractions of making a gift now. So the first one is the one that we've been talking about this morning, and that's that we're going to be potentially paying capital gains tax at a lower rate. So if we're looking at transfer of investments, by way of an example, we're talking at a 20% rate versus potentially a more than doubling of that rate, more than doubling of that amount, as Lizzie's illustrated. Again, as we talked about, that's starting the 7-year clock ticking from an inheritance tax perspective, which tends to be good news if you're looking to move assets on and outside of your estate. And in many ways, what we quite often discuss with clients is we discuss categorizing those, placing their assets into 2 categories. One is those assets that they are inevitably going to be selling at some stage in the not too distant future. And with regard to those assets, it's going to be a case of effectively bringing forward the tax liability. There is going to be a charge to capital gains tax at some stage, and why not bring forward that tax liability, accepting that you're going to pay tax earlier, but at a lower rate. And that's and they tend to be separate from those assets that you may well be looking to retain within the family for the longer term, that may not be sold at any time in the near future. And another couple of attractions in terms of the lifetime gifting. I talk about attractions. Really, the point I'm making here is that if you were to use the trust or the family investment company option that I talked about, you can still move on assets from a tax perspective, but you can still keep control of those. So you could still be a trustee, or you could still be a director of the corporate. You can still retain control moving forwards of those assets. And of course, in terms of lifetime gifts, you can at the moment make a disposal, you can make a transfer of assets into a trust, for example, and you can hold over. So at the moment, you can defer that liability to capital gains tax. If we balance that up and look at some of the potential risks of making lifetime gifts now, I think as Lizzie's referred to, there is the potential, if some of these changes are brought in, there is the potential that this ability to defer the liability to capital gains tax is expanded. So if you made a direct gift to children, grandchildren, there's the potential that you may be able to defer that liability to tax until a later date, until those assets are sold. And again, if we don't see the abolition or we don't see the restriction of this capital gains tax uplift on death, you potentially triggered a liability, paid some tax, and a liability which would otherwise have been washed out. And of course, whenever you're making a lifetime gift, you have to think about what are the capital gains and what are the inheritance tax implications. Again, it's a point that Lizzie's flagged, that if you were to die within 7 years, potentially you'd have paid some capital gains tax, but not received any inheritance tax benefit, or only received a limited inheritance tax benefit. So if we move on to thinking about the potential abolition of this capital gains tax uplift on death, and we work through a couple of examples, again, to think about what planning you may consider undertaking at this stage. So firstly on there, I've got Paul, and Paul is age 70. He's a higher rate taxpayer. He owns some agricultural land, and that land's worth 300,000. He actually inherited that from his father just over 20 years ago, and at that time the land was valued at 50,000. So we've effectively got a 250,000 capital gain there. Paul does think that land at some stage in the future might benefit from development. There may be some planning potential at some stage down the line. And what he's done at the moment is under the terms of his will, he's provided that land is going to pass directly to the children. And if we just think about that for a moment, then as the rules stand at the moment, the land could pass free of inheritance tax, because agricultural property relief potentially apply for the benefit across to the children. And also we would get that uplift, that washing out of the capital gain, uplift to the 300,000 market value for capital gains tax purposes. But Paul's worried. Paul is worried that that as a result of these proposals, that there will be an abolition of that capital gains tax uplift. He's worried that agricultural property relief isn't going to be around for that many more years, and he's worried as well about the rates increasing. So what did Paul decide to do? What he decided to do was he decided he was going to make a gift of that land now to the kids, and he actually decided he was going to pay the capital gains tax. He's a wealthy individual. He's got plenty of funds, plenty of cash available. he decided he'd pay the 50,000 capital gains tax on the transfer of the land to the kids. Now, it's worth noting that he potentially could have deferred that capital gains tax under Section 165, Schedule 7 of the Taxation of Chargeable Gains Act. He could have potentially deferred it, but he decided he wanted to pay the liability. And one of the reasons is that he worked out that his estate is ultimately going to lose, is going to be subjected to inheritance tax. So there is going to be a 40% charge to inheritance tax at the end of the day. And so by reducing his estate by the 50,000 tax that he's paid, actually it means that £20,000 in inheritance tax is ultimately going to be saved. So the way he views it is that the effective tax loss is £30,000. He doesn't think agricultural property relief is going to be available, so that's an effective rate of 10%. He was prepared to pay, especially bearing in mind he thinks that this land may well shoot up, may well increase in value in the future. So all that growth has gone as outside of his estate. Now there is an alternative to the direct gift. So he could have decided to transfer that land into a trust. He could have held over. He could have deferred the gain. Then the trustees would have been paying capital gains tax on a future sale based on the original cost of the original 50,000. That was the value that he inherited it from his father. The attraction of that would be that he could have kept control himself. He could have been a trustee, perhaps together with a fellow friendly trustee. Okay, so let's look at another example. Let's look at Penny this time. Penny she's got an income entitlement in a family trust, and that trust was set up by her father in the 1990s. The trust holds investments of £1 million, and those investments have increased significantly over the years. Now, those funds would be treated as part of Penny's estate for inheritance tax purposes. Technically, what we're talking about here is it's a qualifying interest in possession settlement. It's a life interest settlement in favour of Penny. It would be aggregated with her personal assets for inheritance tax purposes. So that £1 million is in her estate and potentially chargeable to inheritance tax. As such, under the current rules, there would be this uplift to the market value for capital gains tax purposes on her death. Now, Penny is a widow and she needs this income to support her needs. She doesn't want to let go of this income. And also, she is going to need some additional funds from this trust, some additional capital to support some renovation work that's likely to come up in the not too distant future. Penny's also got 3 children, and what we know is that those 3 children are looking forward to the prospect of their inheritance, because they've all got pretty big, substantial mortgages, and they're going to use those funds to actually reduce the value of their mortgages. So in other words, these investments are going to get sold at some stage. The investment manager is certainly recommending selling some of the investments because the portfolio now it really desperately needs some rebalancing. Some investments have done exceptionally well, others not so well, but the investment manager would really like to sell some of the investments to undertake a bit of a rebalancing exercise and reduce the risk moving forwards for the family. So the trustees do decide to sell these investments, and they sell £300,000 worth of investments. The 300,000 that they sell have got a base cost of 100,000. So, and let's just assume no capital gains tax allowance for now, keep the numbers simple. So we would be looking at a £40,000 loss to capital gains tax under the current rules. Why, or what may be some of the attractions of doing that? Well, it's at that lower rate of 20% capital gains tax. We're going to need some cash anyway. in the not too distant future. So bringing forward that tax liability does make sense to provide the funds that are needed for those renovation works. Again, it's this point about the size of her estate for inheritance tax purposes reducing. So therefore, the effective tax cost is 24,000 rather than the 40,000 headline. And also from an investment perspective, we'll have a better balanced portfolio moving forward. So reducing the risk of potential investment losses looking ahead, and increasing the chance of investment growth. Okay, so let's finally just have a look at business asset disposal relief. So entrepreneurs relief. And the point I'm making here is that for those owning shares in a trading business and they've got the intention, or in all likelihood, they're going to be selling those shares pre-retirement, certainly pre-death, then again, thinking about triggering that CGT liability sooner rather than later may make a lot of sense. So my example is John and Jill. They're entrepreneurs, they're in the 50s, they actually own a number of successful businesses, got a couple of kids, Henry and Harry. They're involved in one of the businesses, it's a property development business, JJ Developments Limited. They are worried about the more penal tax regime in the future. So what they decide to do is they decide to move on the shares in JJ Developments Limited now, got plenty of other assets. So they each own those shares on a 50-50 basis. So what they decide to do is they give half the shares to a family trust. The kids and the future grandchildren are beneficiaries. They exclude themselves from benefiting, but they do retain control because they appoint themselves as the trustees of that trust. And they decide in that case, with regard to those half the shares, they decide that they're going to hold over, they're going to defer the liability to capital gains tax. The other half of the shares, which are valued at 2.2 million, they make a direct gift to the kids, and those shares qualify for entrepreneurs relief. Got a base value of 200,000, so the capital gain is £1 million each. And at the current low rates, on £1 million worth of gains, it's 10% rate. So they decide they'll pay that 10% now, just to make sure they guarantee that they'll be able to move those funds on at that 10% rate. Now, so far as inheritance tax is concerned, once they've gifted those shares, if those shares are retained by the kids and indeed by the trustees, even if they were to pass away within 7 years, then potentially they've gone, they're outside of their estate, they would not be liable to inheritance tax. And if they were held beyond that, if they were sold, but the disposal, the gift took place more than 7 years ago, again outside of their estate, no inheritance tax. So those were a few examples. I hope you picked up a point or two, a thought or two at least. I tried to pull together just a couple of conclusions before we go to the Q&A session. What should you do? I think the point I would really make is that there isn't a one-size-fits-all solution here. It really is important to understand your specific circumstances, to understand your objectives, to understand all the assets comprised in your estate, to actually give advice as to what might be appropriate in your individual circumstances. I've talked mainly about capital gains tax, but clearly when you're thinking about making a disposal, there's a host of tax issues to consider. So we've touched on inheritance tax, there's likes of stamp duty, income tax. You have to consider all the tax implications of any planning, not just hone in on the one. Our our view is that the regime is, as Andrew has highlighted, likely to become more penal. There's a question mark over when, but the rates and restrictions on current allowances are likely to kick in. And finally, paying some tax now, it may save some significant amounts further down the line. And with that, Andrew, I think I'm moving back to you, and I think we're moving on to some Q&A.
Thank you very much, John. So yes, we've had some excellent questions posted during the session and also some ahead of time. I'm going to just decide as I go who's going to take the questions from the panelists. One of the questions I've got here is, our business may be sold during 2021. Will the proposed changes affect the personal tax situation? I wonder if you could take that one, John.
Yes, well, I mean, it depends ultimately when that business is sold. But if the business is sold at the moment prior to any of these changes, then we may be looking at a 10% exposure, as again I think Deborah alluded to at the outset, and in Lizzie and my examples, we might be looking at a 10% exposure because business asset disposal relief applies to reduce any liability to reduce the capital gains tax charge down to that favourable 10%. Whereas if the rates do increase in the future, we could be looking as much as 45% tax exposure. Now that's a huge difference. Of course, we don't know in terms of, I think the question was focused on 2021, if it's sold in 2021. Well, I think on the panel, our view is that we're unlikely to see changes come in the March budget this year, which tends to suggest, well, it suggests to me that the earliest time we'd really be looking at any of these changes coming in is in the autumn budget. So again, I would be, my view is that it's unlikely to see some significant changes, certainly up until the autumn budget, and then there's a bit of a question mark. So if you are going to sell pre the autumn.
Thank you, John. Thanks very much. One of the questions I've got here, which I'm going to put to Deborah, is it concerns a parental home. The parents died in 2013. Basically, the children inherited it. One of those children varied their entitlement using a deed of variation. The others didn't. I think the crux of the question is, could these changes affect the rebasing, which I think until now we would have always assumed happened in 2013, Deborah?
I think so. Historically, obviously, when the property was inherited, there would have been an uplift at that stage, and that uplift was subsequent. Sorry, I'm just thinking of the dates, but I think was subsequent, wasn't it, to when we're looking at rebasing potentially in 2000. So it would have been rebased on death. So that will stick, and I don't think there's any suggestion that anything historic would be changed. So the fact that you still have the asset and it's not yet been sold won't impact.
Thank you very much, Deborah. John, can I come back to you on a question that's about non-residents? So, will capital gains tax cap and tax non-residents going forward? Also a question within that about whether tax treaties can deal with capital gains tax, or tax treaties between the UK and other countries.
So in terms of non-residents, non-residents currently only pay capital gains tax in relation to UK property and UK land. So non-residents at the moment pay capital gains tax. With regard to residential property, they will pay capital gains on any increase in value from April 2015. And with regard to commercial property and land, it's effectively non-residents are liable to capital gains tax on increases in value from April 2019, but non-residents don't otherwise, they don't pay capital gains tax. And I think the second part of that, Andrew, to do with capital gains tax applying to overseas assets for UK.
Yes, and tax treaties specifically, do they deal with capital gains tax?
So tax treaties typically do deal with capital gains tax. So if you are a UK resident, it's worth making the point that you are liable to capital gains tax on your worldwide gains. But if you realise a gain in another jurisdiction, you may well pay tax in that other jurisdiction, and it will depend upon the individual tax treaty between the countries as to who pays, as to how much tax you pay. But typically, what you would have is typically you'd pay tax in the one jurisdiction, then you'd be given a credit for that tax that you pay in the UK, for instance, if you're looking at selling property abroad.
Thank you very much, John. A couple of more quick fire questions I'm going to put to Deborah. I'm going to give you both questions, Deborah. The first one is a question about investors' relief. Would the abolition of investors' relief affect holdings in qualifying AIM stocks? That's one. And the second one is, basically, does this impact, could capital gains tax impact on shares sold within pension funds?
So for investors' relief, I'm not sure what relief they're particularly. So the investors' relief, if that's cancelled, that in terms of, I'm not sure if that question was sort of slightly alluding to the inheritance tax relief that AIM shares get, which it will have no impact on that. So investors' relief is very much about a capital gains tax rate that applies to qualifying investments in trading companies, and if that exemption is scrapped, then that will obviously impact on all the potential, the holdings or future investments in that regime. So I don't think AIM particularly has an impact there. In terms of the other question, in pension schemes, so I don't think there was any particular mention. So pension schemes are exempt from capital gains tax. So there's nothing in the report making a suggestion about changing capital gains tax in pension schemes. So I think they're thankfully off the table at the moment.
Thank you, Deborah. I'm going to give you another question, which is about reducing CGT. It's saying if someone is a lower rate taxpayer, would one option be to reduce your income so that you fall into that tax rate before you trigger gains?
Yeah, that can have, if you can control your level of income. So at the moment, you will pay a lower rate of capital gains tax if you're at basic rate. So if you have, so basically your capital gain is added to your other income to work out what tax rates applies. But if you are able to control your level of income and you crystallize a gain that's within your available lower tax band, then you would get the benefit of the lower rate. Of course, if you've got a very large gain, the gain itself could take you into higher rates. So it is treated as that top bit of your income. So if you can control your income, obviously it drops down and potentially is a lower rate. So definitely there is some planning around that, yes.
Thank you. I'm going to just do one last question again to you, Deborah, particularly because it relates to family investment companies, which is your specialist subject today and generally. So the question is, I'm just going to read it word for word. If the asset is transferred to a family investment for shares, there is no CGT payable. Is this likely to change? And will the profit on an eventual sale be liable at corporation tax rates? That's the question.
Okay, so if an asset is transferred to a family investment company in return for shares, it's not actually the case that for all assets you would have no capital gains tax. So you'd need to fall into some form of reorganisation rules in order to actually defer the capital gain arising. So, for example, if your family investment company was purchasing a 25% stake in your trading company in return for an issue of shares, you could fall within reorganisation rules to avoid a capital gain charge. But if think of a different assets, if you had a commercial property that you were selling to your family investment company, you would actually trigger a capital gains tax disposal. So your family investment company would acquire the asset at its market value, but you would have incurred a tax charge. Obviously, when we look at family investment companies and companies generally, when they buy and sell assets and make a gain, the gain is then taxed corporation tax, which currently looks very attractive at 19% versus potential increases in personal rates of capital gains tax. However, it was interesting, picking up on the report generally about identifying how the tax regime generally should look at equalising it so that people's behaviour isn't impacted by the tax regime. And if they see, as they might have done quite a transition of wealth into a corporate regime at the moment because of those lower corporation tax rates, I think if we have some wide, adoption of some of the proposals in this report and the other reports we've seen on inheritance tax, it is also likely that they might look at the taxation of companies and say, why should you only pay at 19% in a company if you're paying at 40% as an individual? And that distortion we are likely to see being on the agenda for change, I suspect, in the future as well.
Thank you, Deborah. That sounds very much like a watch this space, because, whilst we've talked about specific proposals, there's a mood, isn't there, and an atmosphere around, the need to potentially raise more taxes. That means that we ought to be vigilant around what other changes might happen within other regimes. I'm going to just take that as the chance to bring the session to a close. We've just tipped over the hour there. Thank you very much to all of our speakers. Thank you to everyone for attending. As people leave the webinar, they will be asked some questions in terms of feedback. We'd be really grateful if you could take the time to reply to those. Also, all participants will receive a copy of the slides and a recording of the presentation via email. So thank you very much for attending, and I hope you all have a good day. Goodbye.